It's great to have you. And as we look to sort of, the last time we visited was 9 months ago. It's hard to believe it was back then in April, on April 27th. You said you thought we were going to retest the lows then and we'd take them out. We, of course, did not, and we're 71% higher on the S&P 500. So where are we now as you look at this market?
Well, we're at extraordinarily high valuations is where we are. That's being supported by massive amounts of stimulus, obviously. And one of the things that's fascinating is you go back for decades of stock market data, there are many valuation metrics that are in the top 1 percentile of overvaluation. So the thing that's keeping it going, though, of course, is the Fed. The Fed, with rates at zero and promises to stay at zero, allows for valuations to be record-breakingly high. And that's where we are. Also, what's very important for a lot of people to understand is that many things that have been persistent trends relative to equity performance have started to reverse one after another after another. For example, emerging markets are outperforming the United States. Value is outperforming growth. Weak balance sheets are outperforming strong balance sheets. It goes on and on. And some of these things are getting fairly convincing. Just look at the Russell 2000 in the month of November. It had its entire year's return, basically, at least through the end of November, in that single month, up something like 16, 17%. So things are definitely changing. The leadership of the United States being the top performing market for 10 years, basically, has seemed to reverse. And the Super Six, as I've been calling them, the FANGs plus Microsoft, are no longer outperforming. So it's interesting that the generals that led the charge to one of the greatest market outperformances from the U.S. versus the rest of the world, and just an outright nominal returns space, have really left the battlefield. So a lot of things are changing, and I suspect that this is not a short-term phenomenon. Of course, the other thing that's really changed is interest rates have stopped falling. And back when we were talking back in March or April, on intraday low, the 30-year Treasury bond got to 71 basis points, and it's over 100 basis points higher than that right now. So the yield curve is steepening, the dollar is falling, the U.S. is underperforming, and these are important things for asset allocators to consider.